The tech sector steered US stock markets on a pandemic boom last year. Now, markets are whipsawing on fears that the Federal Reserve will end the period of easy money, all while an implicit war in Ukraine looms. Some forewarn of a bigger correction to come on a scale not seen since the dot-com collapse of the late 1990s. In today's video, we're going to talk about the super bubble the US might be in right now. But before that, make sure you press that red subscribe button along with that tiny bell icon to get updated every time we post new videos. Let's get started. On Monday, US stock markets crashed, then rallied. The Dow Jones at one point lost more than points before ending up just over 100. Tuesday was more of the same, with the Dow losing 800 points only to gain a max of it back. Forecasters anticipate more unpredictable days ahead. The Fed on Wednesday issued its rearmost update on its plans to raise rates in order to check inflation, and the world's largest tech enterprises are preparing to issue their latest results to investors, who appear to have grown more skeptical about their prospects. Jeremy Grantham, the British co-founder of Boston-grounded investment manager GMO, believes the US is now in a super bubble similar to the dot-com period, the Wall Street crash of 1929, and the realty market madness of 2006. It isn't just tech that has blown up, but housing prices, commodities, and bond prices. He ran through his list of a late-stage bubble, of which the most important and hardest to define is the touchy-feely characteristic of crazy investor behavior. On that score, he has hard to dispute instances, the meme stock merriment of a year ago, Dogecoin, a parody cryptocurrency, rising to a value of $90 billion because Elon Musk kept joking about it, and shares in auto hire establishment Hertz soaring because the company said it would order some Teslas. Those occurrences are now over, reckons Grantham, and we're on to the vampire phase of the bull request. Share prices have defied COVID, the end of quantitative easing, and the pledge of advanced rates, but just as you're beginning to think the thing is completely immortal, it finally, and perhaps a little anticlimactically, keels over and dies. It's strong enough, and there are, of course, counter-arguments. Commercial earnings are not, on the whole, collapsing. The easing of the Omicron variant may shift Western consumers down from consumption of goods and towards spending on services, which could take the edge off current inflation worries. The end of the period of ultra-loose financial conditions could still be phased. On the other hand, one should also remember Grantham's warning a time ago that great bull markets can turn down when the conditions are still favorable. They just have to be subtly less favorable than they were yesterday. He isn't always right, but he's a serious scholar of markets who called the dot-com and 2006-2008 crashes with impactful perfection. He's worth hearing too. Apart from Ukraine, the debate he's describing is exactly the one obsessing investors presently. The test of this thesis has been a long time coming. So that's all for today's video. Let us know your views in the comment section below. And don't forget to like this video before leaving. Thanks for watching.